How do billionaires legally avoid taxes while most people pay every month? It's not a loophole, it's a strategy. You've seen headlines about Jeff Bezos or Elon Musk paying less tax than their secretaries. It sounds unfair, but it's legal and available to anyone who understands the rules. The secret isn't hidden tricks. It's about how you think about income, assets, and debt. Welcome to Moneyverse, your guide to money the rich way. Today we'll break down the three main methods the wealthy use to pay almost no tax, how they get paid, how they spend, and how they protect their wealth. By the end, you'll see the tax system isn't one size fits all. The rich play a different game, and you can learn the rules. Smash the like button, and let's dive in. The wealthy pay less tax because they avoid salaries, the most heavily taxed income. When you get a paycheck, taxes are taken out before you see your money. The rich know this and choose not to get paid that way. Instead, they take minimal salaries and build wealth through assets, stocks, real estate, and businesses. If their stock doubles in value, their net worth soars, but they owe no tax until they sell. The average person lives off taxed income. The wealthy live off growing assets. When they do sell, they pay lower long-term capital gains tax, often half the rate of regular income tax. The government incentivizes investment with these lower rates, and the rich take full advantage. CEOs often take $1 salaries, but receive stock options and equity, far more tax efficient than cash. Their goal: convert income into appreciating assets, deferring taxes for years. Imagine, you get paid in eggs and taxed on every one. The rich keep the chickens, letting their flock grow tax-free. Step 1, avoid salaries, get paid in assets, and let your wealth grow untaxed. But if their money is tied up in assets, how do they fund their lifestyles without selling? That's where the next strategy comes in. Let's move on. The ultra-rich don't sell assets to fund their lifestyles, they borrow against them. This is the buy, borrow, die strategy. Say a billionaire wants $50 million for a yacht. Instead of selling stock and paying millions in tax, they borrow against their portfolio. Loans aren't income, so no tax. They get cash, pay low interest, and their investments keep growing. Their assets might earn 7 to 10% a year, easily outpacing the loan's interest. They buy appreciating assets, borrow against them for tax-free cash, and never sell. When they die, their heirs inherit the assets at a new, higher value thanks to the step-up in basis rule, erasing capital gains tax. The estate sells a small portion to pay off loans, and the rest passes on, tax-free. This cycle lets wealth grow, be spent, and transferred with minimal tax. And it's not just for billionaires. Anyone with a sizable portfolio can use securities-backed loans to access cash without selling. The key: use debt as a tool, not a burden. The rich unlock liquidity without triggering taxes. Most people fear debt. The wealthy use it to avoid taxes and build more wealth. Recap: buy assets, borrow against them, die, and pass on wealth tax-free. It's the ultimate legal tax dodge. But there's one more tax to beat: the estate tax. Here's how the rich protect their fortunes for generations. The final tax hurdle is the estate tax, a big hit on inherited wealth. The rich use trusts and LLCs to shield assets. Trusts are legal entities that own assets for beneficiaries. The most powerful are irrevocable trusts. Once assets go in, they're out of your estate. This means billions can be passed to heirs without triggering estate tax. Special trusts, like GRATs, let appreciation pass to heirs tax-free. LLCs and family limited partnerships add another layer. Families pool assets in these entities, then gift minority stakes to heirs. Because these stakes lack control, their value is discounted for tax purposes, allowing more wealth to be transferred, using less of the gift tax exemption. These structures also protect assets from lawsuits and creditors. Picture: Russian nesting dolls. Trusts own partnerships, which own LLCs, which own assets. Each layer adds protection and tax benefits. Setting this up isn't simple. It takes expert lawyers and accountants, but the result is a fortress. Income tax avoided with assets. Capital gains avoided with debt. Estate tax avoided with legal structures. The average person has a will. The wealthy have a web of trusts and companies. This is how fortunes are preserved and grown for generations. The tax code is the blueprint, and the rich build their financial empires within its rules. Now, let's see how you can apply these lessons. Here's how to start thinking like the wealthy. The ultra-wealthy minimize taxes by owning assets using debt and protecting wealth with legal structures. This isn't cheating, it's understanding the incentives built into the tax system. You can start small, invest in index funds, real estate, or a business. Prioritize owning, not just earning. Even if you can't set up trusts, you can use tax-advantaged accounts like Roth IRAs. Shift your mindset, be an owner and investor, not just a consumer. The system rewards owners, so play the game by their rules. For more strategies, hit subscribe. We'll keep breaking down how money really works. Thanks for watching. Smash that like button and see you next time.